The broadcast is now starting. All attendees are in listen-only mode.
Hello, this is Jennifer Schaus, and we are continuing on in our 2017 summer series for the government contracting webinars. Thanks everybody for joining us today. And we are joined by Josh Etamati of SBA Bonds, who will be going through a presentation in just a moment. So our series are running pretty short as far as content, so we should be wrapping up around 12:30 today. And as we get started here, just wanted to let you know that all of our webinars are listed on the website under jenniferschaus.com, the webinar section. These are all being recorded, so in the event that you need to jump off early today, you can always go back to our website in a couple days and we'll have the recording posted there. If you need a copy of just the slides, I would direct you to Josh, and his contact information will be listed later in the presentation. A little bit about us, based in downtown Washington, D.C., and provide various services for government contractors ranging from GSA schedules, 8A certification, contract administration, and so forth. We've also got some networking events that we host, typically over at the Kennedy Center in Washington, D.C., so if you join our newsletter, which is complimentary, and you can sign up on our website, you'll stay abreast of some events that we're hosting. A little bit about me there, but more importantly, I'd rather dig into Josh's short debrief on his background, and then we'll let him get into the meat and potatoes of his webinar. So Josh, thanks again for joining us. I'm going to mute my phone and hand the controls over to you, and appreciate you sharing your time and your insight today.
Thank you, Jennifer, and thanks for all of you who are attending today. My name is Josh Etamati. I'm located in Herndon, Virginia, just outside of the DC area. But I've been in the bonding business for about 10 years. You'll see my contact information there, and I'm very excited to talk to you about the bonding process. Construction bonds, a little bit about us. We are a bond specialist. We specialize in small and emerging contractors. I would also add the distressed contractor list there as well. I got started towards the end of the recession, or towards the beginning of the recession rather, and dealt with a lot of contractors who came across hard times, and we were able to help them keep their bonding in good standing, and now they're much better off in the long run. You'll also see that we were the first ever Small Business Administration Surety Bond Producer of the Year. And this is what we do. We do bid, performance, and payment bonds. You'll see our website there, and also our parent company. We are a division of Murray Securus based in Lancaster, Pennsylvania. So I tried to give you a background on all the different things about bonds. I have it broken up into 5 sections, and I'll try to power through most of these things. We'll talk about, first off, what is a bond anyway? And to get to the core definition of it, it's much different than insurance, whereas insurance is a 2-party agreement between the principal and the insurance company. You get into an accident, you hope your rates don't go up, but the insurance company ultimately pays. The surety agreement is a 3-party contract between the principal, which is a fancy word for contractor, or you, the person who's actually performing the obligation. The surety, who's ultimately making the guarantee. Now that's the bonding company or the insurance company. And then the obligee, that's also a fancy word for owner. Now that can be a bank, that can be a owner of a project, or that can also be a general contractor. That's the person who wants the work to be performed, and the person that's hiring you. Now, what is a bond anyway? We use the 3 C's as a way to kind of analyze and put together a bond package: character, capacity, and capital. And a good example that we use is co-signing for a car loan. So if we first look at the first C of character, we would ask the question of well, who would we co-sign for? And the next slide here should show our favorite character example, Bernie Madoff. That's probably not somebody that we would co-sign on a car loan for because they don't have a great background, they don't have a good reputation. But the next one, the next guy we'll take a look at, does have good character and has a good background and good reputation. And as we look at the types of cars that we're going after, we look at the capacity. You know, are we looking to co-sign for a Ferrari or a Lamborghini, or are we looking to co-sign for a Honda Accord, which should show itself here shortly. But that's what we do in terms of bonding. You know, we look at it, the character of the contractor, that would be resumes, references, your reputation. We might look at, well, we will look at your credit. As far as capacity is concerned, we look at the type of work that you're going after, the size of the project versus what you have historically done. And then capital being, well, what are you bringing financially to the table? Do you have good, do you have a good accounting systems? Do you have good estimating? Do you have cash? Do you have working capital? Which we'll go into a little bit of detail later in the presentation. And then what we do is we package those things together as an agent or as a broker, and we submit that to a bonding company. And as a broker, I only get paid when the bond company says yes. So it's in my best interest and our best interest to try and get you as much bonding as possible. The fourth C that we talk about is commitment, and that's the indemnity agreement that you will sign with the bonding company. And that's the guarantee that you give to the surety that, hey, if things go bad or if I run into a challenge on this project, I'll make it right. Because ultimately the bond company is going to have to come up and pay the bills or perform the contract. And if they have to do that, they will look back to you to make sure that they are paid in full. And so as the third bullet point points out, we know everything about you. We know about your business, we know about your staff, your organization, and your entire background. Now we'll talk briefly about the different types of bonds. The ones that we really specialize in are bid, performance, and payment bonds. A bid bond is what's required at the beginning of a bidding process. And the best example that I can give is comparing it to an earnest money deposit check when you're buying a home. So you go to a mortgage broker and the mortgage broker says, okay, you can qualify for a $500,000 house. When you go and you put in a bid, you know, to contract for that house, you need to give them an earnest money check for $5,000 that says, hey, if I back out of this and change my mind, you can cash the check. And that's essentially what the bid bond is. It's kind of a, you know, pre-guarantee that, hey, I'm qualified to perform this contract and I'm giving you a 5% or 10%. And if you're working for the federal government, 20% guarantee that says that if I'm low and you want to give me the contract, that I will provide the following two bonds, which is the performance and payment bond. And so the performance bond is pretty self-explanatory. It's a guarantee of performance. It says that you will perform the contract in its entirety for 100%. And so what we do is we'll look at your contract and we'll review some of the terms and conditions and, you know, make sure that you have the capabilities and are aware of what you're going to be performing. And that could be things like warranty provisions. Maybe it's or maybe the GC squeezed in a 5-year workmanship warranty and you don't want to be on the hook for that. Or they might have some pretty tough damages clauses in the contract that if you don't complete by a certain date, that there would be liquidated damages. And so we look at your ability to perform that work, and then we provide that guarantee. And the premium is based on that contract price. So whatever that contract price is, if it's a $100,000 bond, we issue a 100% performance bond, and then the premium is based on that price. And if there's an overrun, you know, meaning change orders, there is additional premium to it. But conversely, if you have an underrun or a deductive change order, there is a return of premium as well. And the same goes for the payment bond and how that's looked at as well. But the payment bond is more of where we see contractors facing the ability to qualify for a payment bond, is that, you know, we want to make sure that you have the ability to pay all your bills. And that includes your suppliers and subcontractors and even second tier suppliers and subcontractors that work beneath your subs and suppliers. And what that does is that protects the government from a subcontractor filing a lien on a federal property. And the payment bond is that guarantee. And so that's why we're looking at your financials and making sure that you have the capability to do that work. Now, what impacts your bond program? We put this graph together, this little chart of the three parties, the surety, the contractor, and the agent, and right there in the middle is what makes up your bond program. But what you'll find is when you look at the next slide, we'll see really who impacts the bond program the most. Now, we can't blame the surety. The surety has their box and they want things to fit a certain way, and there's over 400 surety companies out there, so everybody has their appetite. The agent has a little bit more control over the qualification of where you can fit your bond program. They know the markets, they can maybe find a better place to fit it, but really the contractor is the one who has the most control over their bond program. And so here's some things to look at when you're looking at the surety and you're qualifying the surety as a contractor. You want to make sure that the surety company is AM Best rated. There's a website which is ambest.com. You can type in the name of the surety company and make sure that they are in fact rated by the AM Best Bureau. You also want to make sure that they're treasury listed by the federal government. And there is what we call a T list, and I'm happy to provide that website for you. That will tell you what kind of capacity that surety company has. But you want to make sure that the surety is a good fit for you. You don't want to be a little fish in a big pond. Maybe your goal is to be qualified to get bonds through Travelers or Hartford or Liberty, but maybe you might be too small for them at the time. But then on the other hand, as you grow, you also don't want to be a big fish in a small pond either, where you're too big for their capacity and they can't help you. Some things you should be asking yourself is, have you met the underwriter yet? Have you had a conversation with that underwriter in person? That goes a long way in improving your bond capacity. And then also make sure that there's not a whole lot of turnover within the surety company. Make sure the underwriter has been there for a while, has a good reputation, and make sure the surety has a good relationship with the bonding agent. When you're qualifying the agent, you want to make sure that that person's a trusted advisor. That's a person that you can call and talk to and ask questions and pick their brain on things that you want to do. That agent should understand surety bonds. There's a lot of great insurance agents out there that do a great job at insurance, and they may dabble in bonds. So keep that in mind, that not all insurance agents understand bonds. But make sure they also understand the surety markets. It's not all about standard bonding credit. If you're a small and emerging contractor, there's access to a lot of different markets aside from just standard bonds. So just because you don't have the best credit, or you may not qualify for that standard bond line, it doesn't mean you can't get a bond. It just may mean you need to talk to the right agent. And then understand the politics within each surety. So some sureties give a lot of authority to their underwriters, whereas some of them require to be involved on every step of the process. And the agent will typically know that. And then make sure that agent is an advocate for you, the contractor. But you'll see here, the contractor really has the most control over their bond process. Now, if you run a good company and you're successful and you make money and you know how to build stuff, you can get bonds. It's just a matter of how you're presenting that to the bonding company. A good contractor that has a good bond program, they understand the process. They have a good relationship with their bonding agent. They give them a call to talk about anything. They consult with the bonding agent regarding, changes to the company or things that they're facing. They have a very close relationship, and they consider the advice. A lot of people, contractors say, well, what's the key to, contractors getting more bonding? I said, well, it's really two things. One, they have to, know how to perform the contract, and two, they have to know how to make money. Everything else kind of falls in place as long as they listen to their agent and to the surety because we're the consumers of this information, and if we can see that you have a strong company and you have good checks and balances, a good project management team, good banking relationships, we can leverage all of that to give you more bonding and to give you more capacity. Now, here's some basic, very key steps to the bonding process. So we kind of get all this. You've heard me talk about the background and who's in control, but in terms of, where do I get started? Well, get started now. Even if you don't need a bond, it's going to help to get pre-qualified, to know where you stand. I can't tell you how many times people have contacted me after they've been awarded the contract and they're in, that they're at the 11th hour prior to getting kicked off the job because they didn't get a bond, and we believe we would have been able to have helped them out if we had a little bit more time. It's important to know where you stand and to know what you qualify for prior to going after that project. That's really step one. Step two, get a good construction CPA. Not a tax accountant, not your niece or nephew or the kid that comes to your church. You want to make sure that it's somebody that understands construction. And I'll talk a little bit about the cost of bonds, but if I told you that getting this statement would save you thousands of dollars a year in your bond rate, you would probably consider it very quickly. And then finally, get a copy of your credit report. You can go to annualcreditreport.com. You're entitled to a free copy of your report once a year. Not freecreditreport.com, not creditkarma.com. Those do charge you, but this is actually a place where you can get a free copy of it through the federal government. Know your score, know what's going on. There are things on there that you might be surprised that shouldn't be, and you want to be able to get those mistakes corrected prior to, getting into that detail of the contract itself. Now, next steps. What I did here is I put together a list of the different programs that are available. We can talk about the history of bonding and all of that, but you might have a bond need right now, or you might be wondering where you fit. And so I put a couple slides together of the different programs available. The first step program, that is, we call it a Band-Aid bond, and it's based on your contractor's credit score. Typically, the programs that we have a handful of programs with different companies like Liberty or Travelers or Penn National that will go up to $500,000. And it's a one-page application. You can get an answer in about 24 hours. Oftentimes, it's same day response. But we call it a Band-Aid bond because it's not a permanent fix. If you want to establish more bonding and increase bonding capacity, this might get you that one quick bond. But really, we should be having a conversation on what you could qualify for and how to increase your bonding capacity. And you'll see the rate there is going to fall between about 2.5% to 3%. Now, the next step program is for contractors that might have a good internal accounting system. So maybe you have QuickBooks or Peachtree, and you keep track of your accounting pretty well, meaning that your cash shows, your receivables are there, your payables are there. There's not a whole lot of negative numbers that are all over the statement. And you can, generally track between the last 2 or 3 years, where you're going and what's going on with your company. So we don't necessarily need a construction-oriented CPA for a smaller program like this. We would probably still have a conversation with that CPA as you're growing, but we are going to look at we're going to look at it like a standard program. So we're going to look at all your financials and your background and resumes and references, and if we can verify cash and your receivables and see that you do make good money, we can generally get support on projects up to $1 million. I put 1.5. Because we have had a few cases where we've been able to go that high, but typically it's up to about $1 million to $1.5 million. And the rate's a little bit lower, but it's not quite where the preferred contractor rate is going to be, which I'll get to shortly. The SBA, that's, like I mentioned at the beginning, we were the first ever Small Business Administration's Surety Bond Producer of the Year. when they first gave that award out. The SBA is a fantastic place to get bonds for small and emerging contractors. They have a way of underwriting that is a lot more aggressive than what the standard market will offer. So to give you an example, if a contractor may qualify for $1 million in bonding in the standard market, in some cases they could qualify for as much as $2, $3, $4, $5 million through the SBA by some of the ways that they calculate working capital and consider your bond program, which I can go into detail if you have a specific case. But as far as some of the details on the program itself, they will go up to $6.5 million for a single project, and they will go up to $10 million on federal projects. If you're federally certified, meaning hub zone, service disabled veteran, or 8A, you can get up to a 90% guarantee versus the 80% guarantee. And even if you've had a bankruptcy or you might have tax liens or issues with your credit, they will work with you. And there's a logo. Specialty programs, there are programs out there for you if you don't fit within kind of the above, the prior ones. Maybe you don't have a whole lot of working capital, maybe you don't have the best credit, or maybe it's a really big jump in job size. Say it's, the biggest job you've done is $500,000 and this is a $2 million job. That's not to say that we can't get it, but we may need to use tools through a specialty program like funds control or project management, where they actually have people within the bond company or an outsourced company that will help manage the project or even provide job oversight. Bonding back subs is also something that helps stretch your capacity. So if you're a general contractor and majority of your work is going to a mechanical sub, shifting that risk down to your subcontractors by requiring them to bond to you not only provides you protection in the event that they fail, it provides that reassurance to the bond company that their work will be done and will be guaranteed, just as if you're guaranteeing to the government. But you'll see the premium is a little bit more expensive and the cost overall is more expensive because there are fees associated with that. So the goal is to get you to a standard program, which is my last slide. And that's for the standard accounts that, need bonds very consistently, typically over $1 million, or they might need a lot of small bonds. They have the max capacity they can qualify for based on their presentation. They probably have CPA reviewed or even audited financial statements, which is a goal that we would be shooting for if you look to increase your capacity. And then, as we get bigger, we talk about the three things: rate, capacity, and indemnity. So typically you would want to try and pick the one that's most important to you. If you want a really low rate, we can push that rate to below 1%. If you want limited indemnity, we can address that. Some people don't want their spouses to sign or may not want to personally indemnify the bonding company. And as you get bigger and stronger and your presentation improves, we can start having those conversations with the bonding company. Or capacity is a big thing. Maybe you want the most amount of capacity based on your presentation, and that's what we'll work on. And so as your broker, our job is to consult with you and to find out what's most important, and then trying to coach you and leverage your strengths to improve your bond capacity. I hope you enjoyed this, and if you have any questions, my contact information is here. I'm typically in the office, but I'm always accessible via email, and I look forward to hearing from you all.
Josh, thank you so much. It was great information, very thorough and complete, and had a good turnout. So thanks everybody for joining us. Thanks again, Josh, for sharing your time, your expertise, and your knowledge. You're a great resource, and obviously your contact information is there. So if anybody has questions, we ask that you please direct them to Josh directly, either by phone or email. And stay tuned, as we still have more webinars coming up over the next, we'll say 6.5 weeks. So we're only 3 days into it and still about 30 more webinars to cover on various government contracting topics. Thanks again, Josh, and thanks everybody for joining us.